Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2025, December 18th, and the market is basically doing that thing where it smiles politely while hiding its hands before U.S. inflation data.
I love CPI days. It's like a group project where everyone pretends they're calm, and then one number drops and suddenly your portfolio needs therapy.
Today, a CPI preview with what it means for rates and everyday borrowing, a China brokerage mega merger by ShareSwap, Micron's upbeat outlook on AI memory demand, and Bitcoin whipping around ahead of inflation data.
Prices, banks, chips, and crypto chaos. Basically the four food groups of modern anxiety.
Story 1. The November CPI report is expected to show annual inflation around 3.1%, per economists polled by Dow Jones. Markets care because CPI feeds expectations for what the Fed does next with interest rates.
Explain it like I'm a person trying to refinance a mortgage while also buying eggs. Why does one government spreadsheet ruin my day?
Imagine the economy is a car, and the Fed is controlling the speed with the brake pedal, interest rates. CPI is the speedometer reading. If inflation is still running hot, the Fed keeps the brake pressed longer, and borrowing stays expensive.
So if CPI comes in higher than expected, it's like the Fed goes, "Cute, you thought we were done," and then my credit card APR does a backflip?
Pretty much. A hotter print can push Treasury yields up, which filters into mortgages, auto loans, and business financing. A cooler print can do the opposite, support risk assets like stocks, because rate cut expectations come forward.
Actionable question for normal humans. Do we do anything today? Or do we just sit on our hands and pretend we're long-term investors?
Two practical moves. First, if you have variable rate debt, consider locking or accelerating payoff. CPI surprises can keep rates higher. Second, for portfolios, avoid making a one-day CPI bet. Focus on diversification and position sizing, because the first move is often not the final move.
Don't YOLO your retirement on one decimal place. The decimal place always wins.
China International Capital Corporation, CICC, announced ShareSwap merger details with two smaller state-owned rivals, Dongxing Securities and Cinda Securities. The combined entity would have assets over 900 billion yuan, about 127.8 billion US dollars.
ShareSwap sounds like trading sandwiches at lunch. Who's giving up what, and why should I care if I don't own Chinese brokers?
A share swap means CICC issues new shares to buy the other company's shares, instead of paying mostly cash. In the filing, it planned to issue about 3.1 billion new A shares at 36.91 yuan to acquire the outstanding shares. It's a consolidation move. Fewer, larger players, potentially stronger balance sheets, and more pricing power in underwriting and brokerage.
So it's like the state is tidying up the financial closet. Fewer hangers, bigger coats, same chaos. Does this mean China wants a national champion broker?
It can signal exactly that. More concentrated financial intermediaries that can support capital markets activity, IPOs, and policy priorities. For investors, it matters because consolidation can change competitive dynamics, fee structures, and risk. Bigger institutions can be more resilient, but also more systemically important.
And if you're holding a China allocation, this is another reminder. Policy is not just a background character. It's basically the co-host.
Story 3. Micron forecasts surging revenue as demand for computer memory tied to AI remains high. One report notes Micron shares are up 168% in 2025, so the market has already been paying attention.
168%? That's not a rally. That's a trampoline with a mortgage. Are we in AI changes everything or AI bubble jitters? Because I'm hearing both in the same sentence lately.
Both can be true. The simple finance, memory is cyclical. Prices fall when supply outruns demand and spike when capacity is tight. AI data centers can increase demand for high bandwidth memory and advanced DRAM, which supports pricing. But when expectations get too perfect, any slowdown hits valuations fast.
So it's basically like concert tickets. When everyone wants in, prices go insane. Then the tour ends and you're stuck trying to resell 2 seats behind a pole.
Actionable angle. If you own semis, ask whether you're diversified across the stack, equipment, foundries, memory, and software, or concentrated in one perfect narrative. And if you're adding now, consider staging entries instead of all at once, because chip stocks can swing hard around guidance.
Okay, take us to Crypto Corner. Bitcoin is all over the place ahead of U.S. inflation data. Why does CPI turn Bitcoin into a caffeinated squirrel?
Because macro liquidity expectations move everything that's duration-like or speculative. If CPI is hot, yields can rise, the dollar can strengthen, and risk appetite can drop. Crypto often reacts sharply. Another related headline, long-time Bitcoin holders have been cashing out, which can add selling pressure into shaky sentiment.
So the diamond hands are quietly becoming paper hands, and the rest of us are just trying to not buy the top at 2 a.m. Got it.
Practical guardrails. Decide your crypto allocation as a percentage of net worth, not a feeling. Use position sizing and preset rebalancing rules. And if you're trading around CPI, assume spreads widen and moves overshoot, so reduce leverage or don't use it.
My rebalancing rule is simple. If I start narrating my trades out loud, I'm done for the day.
Quick recap. CPI expectations around 3.1% set the tone for rates and borrowing costs. China's CICC share swap merger points to financial consolidation. Micron's AI memory demand story highlights both real fundamentals and valuation risk. And Bitcoin volatility shows how macro data can whip risk assets.
And your to-do list is don't marry a narrative, don't fight a decimal, and don't let CPI bully you into panic decisions. Also, hydrate. Markets hate dehydration.
If this helped, subscribe and leave a review. It tells the algorithm we're not just two people yelling about percentages. Comment with your plan. Are you hedging rate risk, adding on dips, or sitting tight until the data clears?
And if you're listening right before CPI, breathe in, breathe out, and remember, your budget is more important than your hot take. See you tomorrow.